Good afternoon. Welcome to a Tricio webinar. Usually our webinar talk about macroeconomics and investment strategies. This time we're going to do something different. We're going to talk about sustainable or ESG investments. But we also want to touch on more fundamental principles about sustainable investments. And the theme is time to rethink ESG investments. One thing I want to mention at the beginning, before we go into details, is that sustainable or ESG investment actually is something relatively new. A lot of people will try to say that, yes, a lot of we have long experience in running sustainable fund, or we have been doing ESG analytics for years, but actually it's probably at most 15 years history. Before that, these type of investment were run as responsible or ethical investments, mainly driven by, for example, Islamic mandate or Christian mandates or some charities portfolios. They want to exclude or screen out companies that they think are harmful or they think they're immoral or against their principles and beliefs. So that's the beginning. But over the years, as we start talking about more about global warming, climate change, also social injustice, etc., people start thinking about integrating these factors into portfolio. And the old ways of just excluding harmful companies may not work. So to run this year, the ESG or a sustainable investment, they start thinking about these three letters: ESG, environment, talking about not harming the planet, doing good for the environment. S, on the social side, making sure that actually social factors taken into account. And G, on governance, making sure companies are run and governed properly, shareholders' rights are protected. So this is how it develops. And this is only really last 10 to 15 years, as I said. So remember that this is still new compared to a lot of other investment strategies we've seen over the years. And anything that is new, especially in finance investment, is evolving, will have a lot of debate. You see things that actually become very, very hot, looks very positive, and suddenly we have a lot of things that sounds very negative. So that's the agenda today. We first cover these aspects. The inconvenient truth. You probably heard of that. That's one a documentary by Al Gore. ESG also have some inconvenient truth. You may not know about it, but recently we read a lot in the press about claims of greenwashing. That's when these come out. As I said, ESG or sustainable investment are new, and therefore, at the moment, it seems to be doing a phase of rethinking, and that's what we're here to do. And we do rethinking, we want to ask this question: is sustainable investment really have an investment case? Some people may have a disagreement on this. Some people may say yes. So we'll look at some of the factors here. And lastly, I want to quickly conclude with how we could actually match investor expectations on sustainable investments with some of the investment realities there. Now, as I said, ESG at the moment seems to be catching a lot of relatively negative press. And here are some headlines from the Financial Times recently. You probably had heard of HSBC and DWS, these big fund managers having some issues, especially if DWS have been raided by German police on related to ESG claims. And then you got the SEC in the other side of the Atlantic investigating ESG claims. Here is the investigating Goldman Sachs. They also find another firm basically for making misleading claims about the ESG process. And therefore you got these opinion pieces as well, and equating ESG with BS, saying that ESG is creating confusion there. So these are the headlines. But probably the biggest story came last May. Yes, it's him again. Obviously, his eyes was on Twitter, but also his eyes were also on these guys as a Standard & Poor's, S&P, Dow Jones indices. You probably read a lot about this in the press. And what actually happened is summarized by this tweet. About mid-May, Mr. Musk is complaining and that ExxonMobil is rated top 10 best in world for environment, social, and governance by S&P 500, while Tesla didn't make the list. ESG is a scam. It has been weaponized by phony social justice warriors. And he go even that actually further and say that despite Tesla doing more on the environment, the ESG score doesn't score high. So it must be because they have a leftist agenda. So that's what happened to between that fight between Elon Musk and S&P. We dig into a little bit more into this because what this story told us is that three things. Firstly, ESG now has become a must-have story for companies and investment houses. I'll explain why later. Secondly, is that ESG is a good attempt to try to simplify things for investors in sustainable investments, but at the same time, it probably has hidden some subtle complexities. And lastly, is that ESG can be understood very differently by different people. So let's go to the first thing. Corporate must have stories. We have heard of FOMO, fear of missing out. And ESG companies also probably fear of missing out on ESG. They don't want to be seen of not being on the bandwagon of being friendly to the environment, doing good for the society, and have good governance structures. And the reason is that there's a halo effect. When you basically associate yourself with ESG, people like it, your company looks better, institutional investor, pension funds will invest in you. And that halo factor probably means everyone want to say something that they're doing good on ESG. And more importantly, because nowadays clients and people want to hear good stories about the business or companies that they invest in or they do business with are actually complying with the climate change, doing good on the society, etc. Telling clients what they want to hear makes lots of commercial sense. So latest trend now, the greenwashing is going into consumer labeling. You probably read in the news is basically some people make claims about their plastic packaging, recycled plastic and things like that, which may not be entirely true. But that's what we as customers want to buy. Want to buy a plastically packaged product, and the packaging at the back says that don't worry about the plastic, it actually is recycled, it's ocean friendly. May not be the case. Telling clients what they want to hear is what is driving these trends, and probably the greenwashing we're seeing by companies and investment houses. The second thing about ESG is that it simplifies but also high subtle complexities. Now, it's an important concept, as I said, starting with responsible investment, ethical investment. Now we want to actually run investments that put capital into companies that are sustainable, run business in a sustainable manner. And how do we make the judgment? Just looking at the environmental factor, the social factor, and the governance factor is a very simple and yet powerful way to implement sustainable investment. So it's also a good way to explain to customers that actually when you invest in sustainable investment, actually to focus on these three factors. But what it doesn't show is the complexity. The S&P 500 ESG index does not include Tesla. And Mr. Musk was angry about it because he thinks that Tesla is doing a lot about the environment. It's got a big E there. But What is not being said is how the index is being constructed. S&P construct this index based on S&P 500 index. And in the S&P 500 index, it covers different industry and sectors. And that classification remains. And what they did is within each classification or industry sectors, they select companies that have good ESG scores based on S&P research. And in that way, ExxonMobil is top there because oil and energy company is still on the S&P 500 ESG index. It's still there. And ExxonMobil score high on the ESG score. Tesla, on the other hand, may have a big E there, but according to S&P, they score poorly on the S social side and G governance side. They quote examples like poor labor relationship and also importantly about accidents related to auto driving features of Tesla cars. So Tesla scored poorly, it's gone out from the index. And obviously, Mr. Musk complained, the E is very big for us. Why is not in the index? Well, because the description of the index that does tell you about the strategy, the index construction process, and the outcome. We have people investing in ESG funds, expecting a lot of renewable energy companies and green technology companies there. And what they discover is that that fund have a lot of banks. They're disappointed, but the ESG label doesn't tell those investors actually how they construct the portfolio, what the strategy, what the score being used, what ratings are being used, how are they actually used in the selection process. And these three words, while friendly, have a halo effect, actually does not help in explaining the outcome and strategy. And because ESG is such an easy concept to understand by people, it can be understood very differently. Now, one of the things that we have been discussing a lot is whether defense companies could be included in an ESG or sustainable fund. Now, remember that actually during the ethical fund era, defense companies are typically excluded. But now it's not the case because of Ukraine-Russian conflict. They think that actually having the weapons and the necessary things to defend a democracy, a nation, about security or energy is important. That actually score high on the S side. So should it be included? That's one debate. Some say yes, some say no. Similarly, should a sustainable fund invest in countries with low human rights standards or records? Many emerging market countries actually do not have very good human rights records. Their government is maybe corrupt. Should we avoid them? Well, in principle, based on S, you should, because you actually supporting government that is doing bad. But on the other hand, you could argue that actually you want to allocate capital to some of the good, better company in those countries because they do need the capital. They make a difference and show the right way of doing things in these developing countries. Similarly, there are a lot of funds now invest in so-called brown companies, not green companies. Green companies, though, actually doing maybe score very well on carbon emission. Brown companies are basically transitioning. If we actually say don't invest in brown companies, they do not have the funding. They do not have the money to invest in the right technology to transform the business strategies and models which is more environmental friendly. And also because of that, that actually represents longer term investment potential for investors. So maybe brown energy companies or emerging market countries in a similar sense, maybe should be considered by a sustainable investment fund. But again, different people have different understanding on this. Now, lastly, are E, S, and G genuinely factors that bring long-term investment performance? Now, I'd like to bring in Jerry now. I'd like to ask him what he thinks actually we talk a lot about this, Jerry, whether actually sustainable investments or ESG actually makes sense for investors looking for performance. What do you think?
Hi, James. I think it's basically the simple answer is yes, you would hope that it would improve long-term investment performance. However, as you've noted, we don't really have that much data. It's only been, like you said, 15 years or so that we've actually had formal ESG sort of factors or criteria. And most of the indices, including the S&P 500 ESG index, only go back to 2010 or so, or maybe even shorter in terms of simulated data.
Mm-hmm.
And it's a lot shorter in actual index performance. But gut feeling, you'd expect that companies that have good environmental, social, and governance practices should actually be good companies to invest in, on the view that they're not going to slip up in banana skins, which is why, like you, I'm puzzled when you look at the current ESG indices or ETFs or funds, and you look at the companies that are in there, and they have a lot of companies that both you and I would agree, I think, have the potential to slip up on banana skins. Banks, financial companies, they've always shocked us with, the hidden surprises that come back and bite us. And as even Elon Musk noted, why is one of the biggest oil companies in the world considered to be a decent environmental sort of company? Obviously the criteria, as you mentioned, that S&P uses, the methodology of constructing their index is critical. What are they looking for? They're looking for improvements, not actual things. So they're looking for Chevron to actually, or Exxon to improve on its current practices. They note that there are, one of the things about Tesla was that they didn't have a laid out low carbon strategy. And, it's one of those things where you look at it and go, okay, maybe, these should pay attention to what these index providers are looking for if you want to be included in that index. And that's important because so many indices are actually driving money into ESG funds that to be left out of that is, as you pointed out, is actually a disincentive to actually improve. So you actually need to put money into these ideas, and more importantly, get the money to the companies that are improving, rather than just the companies that are saying, look, we're a clean energy company, give us all your money. In my view, you need to give it to the companies that are moving away from dirty practices on ESG concerns and moving to better ones. Now, what do I think it's going to improve your performance? It's exactly that, the banana skin. So you don't want to invest in companies that are basically going to do bad things, shut down by regulators, and or fined heavily.
Interesting. Yeah, I tend to agree with you, Jerry. I think given my research background, looks for actually strong evidence about investment factors, I don't think we have enough history to say E, S, and G are like size factors or value factors that we often heard in the investment industry. They're not that. And I show you this slide. You and I discussed it a long time ago. This is the iShares ETF on Global Clean Energy Index. And obviously, this is the price up to end of December last year. It fell a little bit more this year. Now, the arrow points out that rapid rise from about the level 150 to over 250 during the COVID lockdown period. And remember that actually, you could argue is that actually during that time, people realized that the E factor is important and that drives the performance. Look at that. But also, there are arguments which I would tend to agree with is that, hang on a minute, there's also a period that all the tech companies like Facebook or Alphabet, i.e. Google, etc., they all rise rapidly because of the lockdown situation. And a lot of these companies in the iShares Global Clean Energy ETF are technology firms, and they benefit from this rise of growth companies. People are actually looking for growth. When interest rate is also low at the same time, John Cafferly, our chief economist, often mentioned that because of that actually drive people looking for yield and growth become a winning play during that year. Those years. So you can look at that and basically say, is it the E factor that drives the performance, or is the growth factor that relates to tech company in general that drive the performance? So the question mark is out there. So, and this is very difficult to agree And some people will say, yes, there's a E factor. Some people like Jerry, myself, and some other people say, maybe not, the evidence is not clear. And I could say that actually even experts do not agree. Now, this is one of the best quoted thing when people are telling things about they're against ESG. This is the wide range of ESG score. Usually when you rate a company on credit, the rating agency come up with more or less the same credit rating. But that's not the case on ESG rating. Here is actually a chart produced by these academics recently, a very good paper that you could read. And what they did is to compare the ESG rating of some major rating agency like S&P, like Moody's, like MSCI, and compared again another rating agency called Sustainalytics, now part of Morningstar. They all do ESG score. And what they did is that they plot a companies on the horizontal axis is the relative rating from Sustainalytics, and each company's rating by the other rating agency are also plotted on the chart. And what you see is that in the ideal situation, what you see is that a straight line here, a straight line that goes like a slope, like 45 degrees. And that means that they agree perfectly. So if Sustainalytics think the score is 0, then the remaining rating agency have a score of 0 as well. Well, you kind of see there is a kind of a line there, but it's scattered all over the place. So you have some company that actually have a Sustainalytics score of 0. It may be rated close to -4 by one rating agency, and another rating agency close to 3. Wide range of score. They don't disagree. They don't agree. Now, I'm a fund manager. I want my screening based on ESG scoring. This wide range of different doesn't help. Some may say ExxonMobil is high score like S&P. Some may say it's not. If Elon Musk run an ESG rating agency, obviously it gives Tesla full marks, where ExxonMobil probably -100. So that's actually what happens there. A lot of big investment houses actually now hire their own ESG or sustainable investment team, but it actually doesn't defeat the fact that even they may have a different scoring within the team or different companies. So when you actually invest in a fund that use ESG scoring either proprietary or externally, you're also making a bet on actually whether that score really reflects the ESG credential of the company. Bearing in mind that actually that ESG factors are not all measurables. Maybe on the E side, carbon emission, fossil fuel usage, etc. The S side, how about S side? How do you measure diversity? Number of females on the board, does it really measure diversity on the S side? How about how they run the policy? How about the human resources policy about male versus female, etc.? That is not reflected on an accounting metric. How do you actually justify the score of that? And that's the challenge. And that's ESG concept looks very interesting and simple and appealing, but you actually start running these scores, you run into difficulties. Now we talk a lot about the negative side, sounds like bad side about ESG or sustainable investments. Does it mean that we should stop doing it? A lot of people say, well, it's too negative, there's no performance case, maybe we should ignore it, it's too complex. I'll argue otherwise. There's an economic case for all sustainable investment. There's an economic case for investor allocating capital to businesses or companies that run things that are ESG compliant or in a sustainable manner. And I show a pie here because it relates to the book called Grow the Pie by Professor Alex Edmonds, a professor in London Business School. He wrote that book. It's highly readable, and I strongly recommend everyone to read it. And he actually made a very strong case that actually companies can purposely do good, run it in sustainable manner by having a mentality growing the pie. What does it mean? People call it pie economics, and here is a chart there. Left-hand side is basically what we have understood. A company creates value, and the value is actually for stakeholders and investors. That means shareholders. Shareholders get profit, stakeholders get value. For example, they get employed because company grows. They actually get, the company grows, the money is being invested to help improve things. That's the stakeholder side. Now, what has been the traditional way of looking at companies when you invest is to look at actually the size of the slice here. I want to select companies that maximize the profit. And I look at maximizing the percentage of the slice, make it that portion bigger. But what they haven't thought about is actually companies can try to do good and make the pie grow bigger. You may have shared the same percentage terms of the slice of that value, but yet in monetary terms, it still means expanding profit for shareholders, at the same time, expanding value to stakeholders. That's pie economics. That's why you grow the pie. And to do this, there's a lot of other ways that I'm not going to talk about how management need to do when they look at running the companies. But some of them actually means that looking at these companies, selecting these companies actually are not the same way as we've been selecting companies. You need to put in a slightly different framework in addition to how we actually select companies based on financial performance. And for sustainable investment, you have to making sure that growing the pie is important rather than just looking at my slides. So when you apply to ESG, always look at companies that are trying to do good and trying to basically grow the pie rather than just growing my slides. So when you look at companies who are trying to do good, you see that how they benefit on the wider society that will help them to grow as well. So it's been an iterative process. The company to make good money, grow the pie, get into the society, society benefit, more people then actually come back and feed back into the slice with more resources with the company, then the slice go bigger and bigger. So that's one way to look at it. Then the other thing about growing the pie is that it involves making difficult decisions. Sounds very easy when I just said that, but often it involves making difficult decisions. Do you want to grow the pie by keeping your labor force happy? Which seems to be the case because stakeholders happy, they actually make more money, they invest more, company benefit, the pie grows bigger. But when they do good, they sometimes with that, when in difficult times like recession times, profit margin actually shrinks. Do I actually keep my labor force happy without cutting people, or actually keep the profit share or the profit margin good? Because otherwise, company does not exist anymore. Difficult decisions, and sometimes being compromises. And the same applies to sustainable investments. When you select companies, you need to make compromises. You need to make difficult decisions, and it's not easy. And it's, as I said, this is something that is relatively new. A lot of managers are learning it, even though they may have been doing it for the last decade. They're still learning to do it. So you need to bear that in mind when you actually look at sustainable investments. Often we talk about long-term versus short-term. Long-term is associated with sustainable investment or sustainable business. You invest in the long term, whereas short-termism is often related to all these quick wins, etc., and inflexible, incompatible, ESG unfriendly companies. Not to be confused inflexibility though. Long-term doesn't mean you don't adapt, especially when you have new innovations, etc. So beware when you actually invest in ESG investments, sustainable investment. Yes, it's for the long term, but do expect your managers, especially those who are trying to make a difference with their portfolio, trying to adapt to changing technology, changing environment, changing social issues and things like that. And lastly, I would say this: what are the investor expectations? Do they want to do just no wrong or purposely doing good? When you grow the pie, that is purposely doing good. When you do no wrong, you just to make sure that your slice at the pie is kept at the same way. Now, you don't want your slice to shrink, and that is how you do things on ESG. What do you want? Does the investor want to do no wrong or purposely doing good? There's nothing wrong as a principle that investors just want to do no harm, try to avoid doing the wrong things. It's fine. But there are people who actually have a high aspiration. They want to do good. Then there's a difference there. And that relates to how different investment products are being run. Some are designed to do no wrong. Some are designed to do purposely good. So apart from economic reasons, there are other reasons for advisors, wealth managers to start looking at sustainable investment, even if you have not thought about it yet. Regulators also have their fear of missing out moment, or they have their halo needs. You must be now doing something about ESG sustainability as part of the regulations. You don't want to fall behind, and that is changing. And in Europe, they now have to put in the advice process, you need to consider clients' sustainable investment objectives in addition to other financial objectives when you do the suitability assessment. That's under MiFID II changes. That may happen in the UK as well, even though we are now no longer part of EU. Bear in mind that actually a lot of the regulations in UK is similar to Europe anyway. So expect that actually, even though you have not think about it or talk to your clients about sustainable objectives that may come, you need to include that in your suitability process. There's also demand from younger investors and next generation investors. Current investors may not care, but the next generation care. They grew up listening to Greta Thunberg and people like that, and they basically think about the environment a lot, and they want their money to do good, not just make money for themselves. Okay, and also when you think about growing the pie, we talk about the companies growing the pie. Fund managers can grow the pie as well, working together on ethical and sustainable investment, ESG investment. There are organizations like PRI, which is formed by fund managers, they're doing that. Shouldn't advisors also be trying to grow the pie together? Given that actually if you participate and make sure that your clients also put money into sustainable way, you grow the pie. You basically put the allocated capital into companies that run well. It's benefit everyone. So that's the case, as I said. So even though there's a lot of maybe inconvenient truth about ESG investment, there's still an economic case. The economic case basically say that there's a genuine reason that by doing good, purposely doing good with a pie growing mentality, you then actually do well on ESG side, and that helps because over the long run, it creates value to everyone, including shareholders. And also there are other reasons than economics, just what I said, regulations, demographics, and your own duty to try to do good. Now, well, however, at the moment, we still need to face this reality, greenwashing. Jerry, it's time for you to help me a bit as well. What do you think? Do you think greenwashing is going to last? We see a lot of these recently about funds, managers, or companies doing greenwashing.
I would say, James, that greenwashing is a reasonable risk in the financial industry going forward. And the reason for that, it's so tempting. And to be honest, it's one of those things where firms probably have to be a lot more careful than they think they are. And the reason I'm saying that is because some of the greenwashing allegations that are being made around the world by regulators is that companies are saying they're doing one thing, but they're not actually fulfilling all the criteria to meet that goal. And in some cases, what they're saying about what they're doing isn't actually 100% accurate if you look at it from a certain angle. Now, I can give you examples if you want. It's one thing for a fund manager to say, yes, we are ESG compliant and we're following a certain criteria. But then you have to be able to back that up and say, what's our criteria? Are we doing our own internal work? Are we using outside sources for our metrics? Are these really good outside sources for metrics? Because anybody can say they're going to be an ESG rater and just come up with any numbers and any metrics they want or methodology, as you've seen S&P 500 do, right? They're a very respected index provider, but that doesn't mean that their methodology suits you, as you pointed out. And it's one of those things where if you're an investor, the last thing you want to do is use what you would consider to be a trusted source and then be let down. And there's so many ways you can greenwash things. I mean, I think much of the media is covering some of the recent allegations made against some of the leading companies in the world, where they say, our plastic is 100% recycled. Maybe it is, maybe it isn't. Our products aren't using plastic. Well, if you look at the fine print, apparently it is plastic. And you're going, how do you fall into these traps? What's going on here? And these traps are so easy to fall into, James, that if we call them all greenwashing, then I think, there's going to be this very sizable greenwashing risk going forward. And that's something investors have to watch out for. Yeah, and it's really tough because you've got so many other things to do. You've got market performance, you've got risk, you've got, any sort of credit problems. And one more thing to watch out for is, am I going to be guilty of greenwashing just because I'm using, one, the wrong metric, two, I don't keep the proper records, three, the people I was relying on are basically, not telling me the truth. And so, yes, greenwashing is going to be a considerable risk going forward.
That's interesting. I quite like what you said about especially the use of this term, a little bit like ESG being used in a very, very different way. Greenwashing seems to be used in a very different manner. Sometimes when you actually, let me use that description, make a mistake inadvertently because your source actually is inaccurate, it may not be really a greenwashing, and yes, you being seen as a greenwasher. So, and my thinking is actually greenwashing is part of human behavior, because we all look for stories, remember? So we want to basically make us look good, because I don't want to miss out on this halo effect. I want to tell people what they want to hear. And also we want to say to people that actually we are doing good and they feel good. That's the emotional aspect. And also expressive needs is about you show them doing good. So actually, I think it's all to do with human behavior. So sadly, I kind of agree with you, Jerry, is that greenwashing is there. It's just like accounting, where people actually try to do frauds or what I say over creative accounting is there over years and decades. It will still happen. And then maybe we also have social washing and governance washing soon. So interestingly, I read yesterday about DWS, one of the fund managers that get caught out on ESG scandal recently. And the governance structure, the shareholder structure of DWS with its major shareholder Deutsche Bank is actually quite weird from a German corporate governance perspective. I'm not going to go into details there, but what I'm saying is that when a company itself, the governance is actually, the corporate structure is not really up to speed or up to the standard that is accepted by shareholders. Do you expect that company to really do well on ESG side? So I think this is one of those aspects that actually lead to more thoughts. Last thing, we all think that regulators will try to help us. They are. You can see SEC doing things. In Europe, they're doing Article 8, Article 9 funds, etc. But sometimes actually they try to pull ESG investment to the other direction. ESG try to simplify things for investors, make sustainable investment more easily understood. Now they actually make it more complex. Article 8, Article 9 funds are actually quite complicated. The regulations run to 500 pages. That's the EU regulations for you. And they expect the SEC regulation about labeling on funds are also quite prescriptive as well. Will they help? I don't know. It may. At least they will stop people buying things that may not meet their expectation. But at the same time, are they actually helping people to understand investment? And more importantly, do we completely remove greenwashing risk? I have my doubts on that. Now, what should we do then with this? I think to avoid investor disappointment, we actually realign what they expect on sustainability with the investment reality. The first step is to spend more time on investor expectations. As I keep saying many times in our monthly columns and also in this webinar as well, check whether investors want to do no harm or do no wrong, or want to deliver a genuine impact. There's a difference between this. Remember, long-term versus short-term, time horizon, and it may take years, especially looking for an impact there. Return implication. A lot of people are looking for above market returns for sustainable investments. At least we need to be critical about this point, especially when we see investors or investment products basically telling you that actually there's a good performance record because they are ESG compliant. Be critical and look at it very carefully. Risk of loss is important because especially on impact investment, when you look at more specific startup or some new technologies, there's a chance that you may lose money on some of these investments. And therefore, it affects how much you put into your entire portfolio. Remember how you actually implement ESG or sustainable investment in your entire portfolio needs to be worked together with your risk and return requirement. There's a reality of trade-off. Remember what I said, running sustainable companies actually means to make investment difficult decisions. Running good sustainable investment portfolio is the same. You need to make difficult decisions. You need to acknowledge their trade-off. You need to be very critical and very open-minded to make sure that actually you adapt to these trade-offs. As a chartered financial analyst, I actually look at some of the writings from the CFA Institute, and there are some ways to describe investor expectation here. I'm not going to go through every point here. There are 5 points there. But basically, some of them are basically just to look at making an impact on the risk-adjusted return when you consider ESG factors. Some are basically more on the principles like ethical investments. Some basically are more on creating an impact and measurable contribution to environmental and social needs, or actually just pick on a theme on, for example, renewable energy. That's a theme. So different expectations there. And that is one way, it's just one institute there to basically tell you how you could actually describe and ask your investors what are the expectations. The second thing, that's the step one, understanding the investor. The step two is to understand the universe of ESG or sustainable products that are out there. And that is actually probably quite challenging, but help are out there with rating agency, research firms, and people like Tricio who are trying to do work with you to understand how to map your customers' needs with the solutions out there. So some checkpoints, the investment objectives, are they clear or vague? Many basically just say, oh, I invest your money to make sure that we actually contribute to the net zero by 2050. Do you think it's clear or vague? It's something that not only you need to make sure you understand, your client needs to understand that as well. What is the investment process? Are they actually the manager trying to just do no harm or purposely doing good? That actually affects the asset allocation process. The way S&P construct the S&P 500 ESG index probably is more tilted towards doing no harm than purposely doing good. Otherwise, you say, why ExxonMobil is in the index? And how do they actually look at some of the non-quantitative metrics? How you measure labor relationship, how to measure some of the social impact that you do, how do you measure the way governance is being considered, the governance structure and control. Some of these are not quantitative. How do they actually measure it? How they engage management actively? The manager should be able to articulate that, and regulators are actually making sure that they do in their annual declarations as well on these matters. And how do they deal with difficult decisions? Weapon companies don't say that everything is wrong in the first way. Look at how they actually make the decision and whether this decision actually makes sense and can be tolerated by your customers. Lastly, that's very important. I always say there's compromises, realities there. Make sure the risk characteristics of a sustainable portfolio or ESG investment, that risk characteristics may be different against a typical market portfolios. Especially when you're purposely doing good, your portfolio may consist of fewer securities than an index fund. And therefore, you expect a higher portfolio volatility. That actually is something that you may need to consider. And again, how much of that fund should be included in the entire portfolio. And all of these relate to how the manager aligns the investment realities with investor expectations. Now, this is one slide that I actually take from MSCI. As one example on how they actually map this investment reality and look at, for example, they look at financial risk, financial opportunities, how the economic system may change and the society may change over a time horizon from today to 2100. And you could basically say that at the bottom, you see different objectives: achieve better risk-adjusted return. Remember what I just shown on the CFA Institutes, the investor objectives there. Build net zero economy, create better living standards. And you could see actually they have different things they could do in their indices, in this case indices, but it's similar to any investment portfolio. What do you want to do? You want to just reduce emissions, the outcome. That is the outcome, reduce emission, and that will be the type of things that we'll do is to control the physical risk and transition risk, and the outcome is that better risk-adjusted return. Don't expect that means that this type of investment will create a measurable impact, a positive impact to the environment. You'll be looking at something that is more cross-spectrum in the investment or the index there. And again, another tool that I would like to use is this. This is produced by the CFA Institute as well. The blue box actually have the different types of processes. This will be described, hopefully, another webinar in future. These 6 types of way to run sustainable investments: ESG integration, exclusion, best in class, themes, impact, and stewardship, or we call activism in some stage, and met with the 5 investment objectives, the ESG related needs there on vertically, which I just discussed. So it's one way is basically see actually which type of strategy map different needs. And this is when you have now a tool to help you say, this fund have those ESG related features because it's run using, for example, ESG integration. With that, you may actually map this investment to those clients who want basically ESG factors being considered in the investment decision to make better risk-adjusted return. But that type of investment product will not be or may not be suitable for people looking for impact. Look at the dots there. When you look at impact, it will be more along the line of funds that are very clear impact objective. And you to see that actually how they have that in the investment process and how they measure it, and also the risk consideration. It may, as I said, have fewer securities in the portfolio. To summarize, I think that when we want to rethink ESG investment, we need to look at two things. This year, I think that we will not talk about alignment. You need to basically see how the terminology, disclosure standards, product disclosure being aligned, forced into alignment by regulators. And then on the other side, which you, wealth managers and advisors in our audience, can actually do, is to look at the advice side. How do you actually look at research rating, investment outcome, and integrate with existing process? And by doing so, you actually can better actually integrate ESG or sustainable investment objective in the client portfolio. I re-emphasize this. Sustainable investment is a relatively new theme. Doesn't mean that we shouldn't embrace it. In fact, there are a lot of exciting opportunities there, and also a good reason when you grow the pie this way that we should do it. But it's evolving. We're here to help, and obviously there'll be more webinars like this going forward and articles as well. But if you want to talk to us about specific ESG issues, you could easily just follow us on LinkedIn or write to us on the email info@tricioadvisors.com. We have inside publication and also support services, and ESG is one of the things that we help you on. I've taken enough time, it's nearly 1 hour, I've overrun. In that respect, I think I would take questions afterwards via email, etc. Thank you for the time. Hopefully we'll do another ESG related webinar very soon. Thank you very much